Hi there, my name's Mike Larson, and I'm the editor-in-chief at Money Show. Today, I'm pleased to welcome Kristina Hooper, the Chief Global Market Strategist at Invesco, to our video interview series. Kristina has been active in the financial industry since 1995, serving as the U.S. investment strategist at Allianz Global Investors before joining Invesco. Kristina has also regularly been quoted in the Wall Street Journal, Financial Times, New York Times, Reuters, and has appeared regularly on CNBC, Bloomberg TV, Yahoo Finance, and Reuters. Kristina, welcome to the show here.
Thanks so much for having me.
Great. I followed your work for a while, and I looked at your recent weekly outlook, and you actually wrote, "It's the start of a new year, but in some ways it feels like it's just a continuation of 2022. After all, central banks are still having an outsized influence on markets." But you also said that we're getting closer to the end of the central bank's tightening cycles. So I was wondering if you could talk a little bit more about this dynamic. How are things the same for investors this year as 2022, and how do you think they're different?
Mike, I think that's a great question. And I probably should have been a little more clear in saying that this is going to be a year of transition.
Okay.
So as we start out 2023, it is the same as 2022, where central banks have this, incredible hold over markets. They really are controlling the narrative because they've tightened so much in 2022. And the question becomes, when are they going to stop? So as we move through the year, we are going to experience a transition. That will occur when central banks hit the pause button. And then markets will pivot. I don't think that central banks will no longer be in control of the narrative, but there will be a new anticipation, and that will be around when do central banks, specifically the Fed, start cutting rates. So this is a year where central banks will still control the narrative, but we're transitioning to an environment that will be, I think, more supportive for risk assets.
Okay. It's interesting when you look at the rate futures market here as we talk in mid-January. It looks like we're pretty much a lock for another 25 basis point hike on February 1st, and then maybe one hike after that before the Fed, as you mentioned, might look to be cutting later in 2023. So I'm wondering, does that kind of fit with where your outlook is, or do you think that the market's being too aggressive or not aggressive enough in terms of this transition process?
I think markets are being too optimistic when it comes to cutting. I think they've got it right when it comes to when the central bank, when the Fed will hit the pause button. I think we probably have two more 25 basis point rate hikes coming to us. But I think the Fed very much wants to keep the terminal rate where it will be for the rest of 2023, and is hoping that it won't have to cut until 2024. I think that's becoming increasingly likely. I mean, so much of it depends on really the U.S. economy and how much damage has been done by the Fed rate hikes thus far. We just don't know yet, but the U.S. economy is surprisingly resilient. So I would err on the side of the Fed not feeling forced to cut rates this year.
Yeah, I'm glad you kind of shifted over to the economic outlook there, because that was where I was going to go next anyway. I mean, we've still seen some fairly encouraging news on the labor market front, and at the same time, some of the forward-looking data, manufacturing and services indices, and of course housing haven't looked so hot lately. So I'm kind of curious as to where you think we stand at this point. I mean, is recession risk severe for this year? Is it being overblown? Where do you fall down on that debate?
So the recession risk is significant, but I do think there's good odds that the U.S. avoids any kind of broad or deep recession. I think it will be much more likely a brief, pretty modest downturn, maybe not even a technical recession. So if you want to sort of describe it as a soft-ish landing, I think that might be appropriate. And that, I think, respects the fact that clearly the rate hikes we've seen, fast and furious rate hikes, have done some significant damage to the U.S. economy, but it is very resilient. We have a strong labor market that is a double-edged sword, right? That can make the Fed be more aggressive. But now that we're getting to the end of rate hikes, it can be a positive because it means that even if we see losses of 1.2, 1.5 million jobs, we still have a relatively low unemployment rate. And that should be something of a ballast in what are likely to be some headwinds coming.
Okay, let's shift a little bit here and talk about investor positioning in the outlook. I mean, last year it was basically an all energy all the time. When you look at what sector was outperforming, you had defensive sectors tending to outperform offensive sectors, things like utilities and staples and so on doing well. We've seen a little bit of a shift early going this year where it's been a little more offensive kind of profile. What do you see happening in terms of where in the market the best opportunities are and where some of the biggest risks lie?
So let me break that down into two responses or two parts to my response. So the
Sure.
first is I think that in the short term, we're likely to see a tug of war between risk on and risk off. That makes sense because the Fed's controlling the narrative and we're not exactly sure what the Fed is going to do, or markets are confident in what they believe the Fed will do, but there's a lot of potential for surprise here. The Fed has surprised before. It surprised itself, right? I mean, at the end of 2021, the Fed anticipated that the Fed funds rate at the end of 2022 would be 90 basis points. They surprised
Just off a
themselves.
little bit.
Exactly. And so I think there's always that potential, and markets are nervous, right? There's a hesitance to really believe that the Fed will hit the pause button. And of course, then there will be question marks around whether or not the Fed will cut rates. So I think we're going to see that tug of war between risk on and risk off. And that means different sectors will perform well at different times, and we'll see shifts in leadership. But I do think we will get to a place when there's greater clarity on Fed policy, and we're likely to see cyclicals perform better as markets look out and anticipate the end of an economic downturn and the start of a recovery. But I think that's a ways off. I think a few months off as we see this push and pull unfold.
Okay. And what about the outlook for bonds at this point? I mean, whether you're talking about treasuries or credit risk assets, high yield and so on. I mean, obviously last year was a year where nothing almost in quotes worked. I'm curious as to your outlook this year. I mean, is it going to be a return to normal, so to speak, where bonds offset your risk in stocks? Do you think we're still going to have that trading together dynamic? What's your view there?
I think it will be better than the recent normal, right? Because we're no longer in an environment of ultra low yields. This is actually our to quote a marketing term, right? This is your grandfather's bond market, right? This is a fairly robust yield environment. And so that's good. That's a good thing for a variety of different fixed income asset classes. Now, we can we can look to history to give us a sense of what's likely to work when. Clearly, investment grade credit, treasuries tend to perform well in the economic downturn, and certainly in advance of anticipating an economic downturn. But as markets look ahead to that recovery, certainly investment grade credit is an asset class that can perform well in the downturn and can stay with one and continue to perform well in the early stages of a recovery. As the recovery unfolds, early on, high yield tends to perform really well, overtakes investment grade, and I think we're likely to see history repeat itself. But we just have to recognize that there are going to be fits and starts before we get to a period when markets are confident that a new economic cycle is beginning, and then we can sort of refer to that playbook and see things, I think, turn out the way they typically do at the start of an economic recovery.
Gotcha. Well, we don't have too
But I
much
will
time. Oh, sure. Go ahead.
Oh, and I would just also add in there munis.
Okay.
That's an area that sometimes gets overlooked, but certainly looking attractive and again a nice component to include in one's portfolio and could perform well in 2023.
Perfect. Well, without giving away the proverbial store as we wrap up here, would you be able to give a little bit of a sneak peek at what you might talk about in New York at the Accredited Investors Symposium? Any, pointers that you want investors potentially to go away from that event with?
Well, it's a few weeks away, and I always try to be as timely as possible. So who knows what surprises I'll have once we get there. But certainly thinking about the opportunities for 2023 and kind of the themes. One, of course, is that central banks will continue to control that narrative, but it will be different
Mhm.
because they're going to be behaving a lot differently in 2023. And who might the beneficiaries be? Um, uh, in terms of innovation, I think that's an area also to be talking about. I
Okay.
mean, we've seen a lot of carnage in areas like technology, and this could be a time for investors to be thinking longer term about the components they'd like to include in their portfolios, the kind of key themes that make sense that could be on sale, at least as we start this year. And one such exciting area for me is cybersecurity. So I'll
Okay.
certainly spend a little time on that as a theme. But I'm also thinking more broadly. And for me, the what I think is going to be the most powerful growth story in 2023 is likely going to be, at least in part, China.
Okay.
China is undergoing a really very significant change in its COVID policy. It hasn't done this, and it has finally reopened. We've already started to see the results of it. We just got December data that shows retail sales were better than expected.
Mhm.
Not good, certainly, but far better than expected. This is a really good sign, and I think bodes well for 2023. There is certainly going to be some negatives to reopening, without a doubt. We could see a significant COVID wave early on, but it is, to me, a net positive in a very big way as we see the Chinese population do what other populations did in reopening: revenge living.
Well, thank you so much for your insights, Christina. And thanks everybody for watching. I really do hope you enjoyed this interview. If you did, you're going to love seeing our experts in person. You're going to get to ask questions you might have about their unique investing approach, interact with some of the smartest people in finance, really a little bit of everything. So definitely click the link in the video description below for more details on how you can be in the room at our upcoming Accredited Investors Symposium. Thanks again. Christina, again, thank you very much for your time.
Thank you, Mike.